Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about GM. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. On Tuesday's Stock Play of the Day, we looked at buying a long call in General Motors before their earnings. So here I'm showing you the long call strategy in the options playbook. We only went out past earnings. The earnings are anticipated to be announced before the open on February 10th. The concept here was that if you were thinking about buying 100 shares of stock and you're a little nervous about the earnings, how could we still participate in that earnings report and have limited risk? So, since we're thinking about 100 shares of stock, we decided to go on out and buy one call option that represents 100 shares of stock. We went a little bit deeper into money. We bought some delta. We bought an 80 delta call option. That meant that if the stock went up one, our option contract should go up about 80 cents. Now, as always, it's not meant to be a recommendation when we talk about these strategies. We're just talking about different ways that you might want to approach different market conditions. So on Tuesday, let me pull up the chart here. Let's see what happened with GM. I have it highlighted here. We have the red line is showing Tuesday at noon Eastern time. It's a 15-minute chart. So here's noon Eastern time on Tuesday. The stock was right about, it was 52.36 approximately. It's a live show, so it was all over the place. This was all day Tuesday, all day Wednesday, all day Thursday, and here we are Friday. The underlying stock is trading at 54.39 as we speak right now, which is up about 2 points from when we started talking about it on Tuesday. So with that said, obviously the long call position is doing fairly well. If we run to the Ally Invest option chains, we see today that General Motors is up about 27 cents. We bought the 48 strike call. We went out beyond February 10th when the anticipated earnings announcement is, and we can highlight that here inside our option chain. This is the 10th of February is when they are looking to announce earnings. And now that 48 strike call option is now a 90 delta, highlighting the delta chain. And that option contract is now trading for $6.70. When we looked to establish the paper trade on Tuesday, the underlying the option contract was trading right around $5.30. So your max risk in this trade would be $530 plus commission if we bought just that one option contract, as opposed to just buying the stock outright with the stock trading around 53. That would be $5,300 to buy 100 shares of that underlying stock. So you were looking at limiting your risk to about 10%. Now, one thing that's kind of nice about buying deeper into money option contracts is on the way up, the delta will increase. So if the stock goes up 1 point, as we see here, we've gone up a couple of points, our delta is now at 90 cents. When we started, the delta was at 80 cents. Now, on the way down, if we are incorrect in our forecast and the stock starts going down towards that 48 strike, which means it would be, right now we're at 54. So you're talking about a 6-point move to the downside. The delta actually slows down. So it gains delta on the way up and it loses delta on the way down. So that's a good thing if you're going to be incorrect on your forecast, in that if the underlying goes down, it doesn't move against you as fast as it moves with you on the upside, if you understand that at all. So you're limiting your risk to the actual premium paid for it, but you also get the benefit of some time value in that option contract. And if it goes against you, you might actually have something to sell. my attitude would be is if it ever came down to that 48 strike, I would just get out of the trade, period, because I want to capture as much time value that we have in this option contract. Now, with that said, we're only going out 14 days from this point. When we looked at the trade, it was 17 days because it was just on Tuesday that we looked at the stock play of the day and talked about this underlying stock. Okay, so if you wanted to, we usually try to give an alternative trade here. Obviously, this is a positive trade that's gone up. You could actually get out of it before earnings. It's made a fairly significant move to the upside at this point in time. But one thing you might want to think about is just rolling into a long call spread. Ideally, I wouldn't want to do this before earnings. And we talked a little bit about this on the Tuesday call because I don't want to cap my upside. But at this point in time, we had a little bit of a run up. Maybe you might want to sell a call a little bit further out of the money and bring in some premium to help offset some of the time value that you first purchased when you purchased your option contract. Now, I would ideally like to wait until earnings and then maybe sell a call against that position. Or if earnings come out and you're still bullish on General Motors, well, maybe you just sell that leap option and at that point in time, buy your 100 shares of stock because we were able to avoid the risk of that earnings announcement. All right, that's going to be it for this edition of the Stock Play of the Day Overtime. Don't forget to click subscribe and ring the bell, and we'll see you this Tuesday at noon Eastern time for the next Stock Play of the Day. Thanks for coming, everyone.